Hello everybody, Tim Kerin here from Mortgage Choice in Kingsley on the office chair today instead of the couch. And you're probably wondering what's going on with interest rates, but what concerns me is whether or not you're wondering more about my black eye. It's not really black, is it? It's a rouge eye. Which one do you want me to talk about first? Well, all right. I'll tell you about the black eye first. So I was playing soccer, I'm a goalkeeper, I'm a five-a-side goalkeeper, and I was like reaching up over a guy that was standing in front of me to try and make sure I got the ball with my hands before he got it with his head. And he jumped up and the back of his skull went straight into my eye. That was last Thursday, it's now Wednesday. And yeah, it's looking a little bit better, or maybe it's just the light. Anyway, it's okay, the violence was accidental. Interest rates, what's going on with interest rates? So, to explain my level of understanding of it, it's probably better to tell a story about 2020. The last 8 months have been pretty dramatic. I think we can all agree. But I think I'm noticing a pattern. Is something happening twice a pattern? Probably not. Does it demonstrate causality? Definitely not, but there's definitely some kind of correlation going on. So what was going on before COVID hit is that fixed rates and variable rates, a good deal on a fixed rate or a variable rate for owner-occupied principal and interest lending, that is someone buying a home to live in and paying off the debt, essentially, were about 3%. There wasn't much difference. And so most people were going with the variable rate because variable rates had been dropping, thinking that maybe that works out to be the better deal over time. Then in March, when the Reserve Bank of Australia had their second meeting in a month, for the first time in history, the emergency coronavirus meeting, they did two main things that spring to mind that I can remember. They did quite a few things. The first was drop the official cash rate down to 0.25. The first time they dropped rates that much, they dropped it down to 0.5. The second time they dropped it down to 0.25. And then they announced essentially a program that the Reserve Bank governor at the time said he didn't believe was quantitative easing, but he knew a lot of people would talk about it as quantitative easing, which is essentially the government buying hundreds of billions of dollars worth of treasury bonds. And that's why we have JobKeeper and JobSeeker and everything else, something else, JobMaker, etc. And why I think a lot of us calmed down, but also a lot of us refinanced and got a really good fixed rate. So what happened when they dropped fixed rates, when they dropped variable rates, the official cash rate for the second time that month, is banks did not follow suit. Banks did not drop their own variable rates in response. However, over the next few weeks, they all dropped their fixed rates, specifically their 1, 2 and 3 year fixed rates, down to about 2.3. Variable rates had been creeping down a little bit to maybe, I want to say 2.8, 2.9, something like that. So now 4 and 5 year fixed rates and variable rates are all around the high 2s, 3-ish%. But suddenly 1, 2 and 3 year fixed rates are in the low 2s, 2.2, 2.3, something like that, across all lenders. Over the course of the next month or two, that's basically what happened. And so a lot of people have taken the option to fix for 1 or 2 or 3 years as a result of that. That toddled along for 7 or 8 months to get to the point where we are now in November. When the Reserve Bank met on the first Tuesday of this month, they decided to drop the official cash rate to 0.1, down from 0.25 down to 0.1. Banks, the big banks, certainly responded by not doing the same thing, but again, the Reserve Bank at the same time announced another $100 billion of, let's call it money printing for lack of a better term. I don't know if I'm allowed to call it quantitative easing. Certainly plenty of other people are. I'm not an economist, but buying just a cool $5 billion of treasury bonds a week just to keep things going. So that is what is happening at the moment, and it's interesting that shortly after that, 4-year fixed rates suddenly dropped. 5-year fixed rates didn't. 5-year fixed rates are still up around the 3% mark. The high 2s, but suddenly 4-year fixed rates have dropped down to join the 1, 2 and 3 year rates. And those 1, 2, 3 and 4 year rates all dropped a little bit as well. So now you can fix for 2 years at 1.87%, or for 4 years at 1.99, 1.98. So that's what's going on with fixed rates. In the meantime, between March and now, variable rates have been gradually dropping a little bit to the point where, not with the majors, you couldn't get 2.39 with the majors variable, but you can with some of the biggest banks in the world who are essentially competing for market share in Australia by dropping their rates. So they're massive global brands, but they don't necessarily resonate as a massive brand here in Australia to people who aren't international, haven't come from overseas. But certainly people like me are helping customers go to those lenders because the rates are really awesome. When someone wants a variable rate, it's not a major that's got the attractive option. It's one of the biggest banks in the world that has a minor presence in Australia. But those rates, even those rates, are still a good 0.2, 0.3, 0.4%, 0.5 even percent higher than what you can fix for 4 years now. So is fixing for 4 years a good idea? I don't know, because every time I've seen a really, really good fixed rate over the last, let's say, 6 years, where I've gone, wow, that 5-year fixed rate is amazing. If someone is fixed for 5 years, and most people don't, a year or two later, now it looks like a high rate. And now they're wishing they hadn't, because rates keep dropping. So I remember when you could fix for 5 years at 5%, 4.99, and I went, wow, it's amazing. 3.99, 2.99. Now, when's it going to be 1.99? Well, you can fix for 4 years for 1.98 at the moment. So I don't know what's going to happen going forward, but there's a part of me that feels like if you fix for, say, 2 years at 2.04 or something, it's not the very cheapest fixed rate you can get, but at least it opens up the option that in another couple of years' time, if rates have dropped further, you could refix again. Whereas if you fix for 1.99 for 4 years right now, you might regret it, but you might not. We might be at the bottom. Certainly the Reserve Bank is saying they're not going to drop variable rates any further. But it's interesting that when they don't really move variable rates much, but they instead announce the printing of hundreds of billions of dollars, fixed rates drop. So I wonder if that happens again. I wonder if this next $100 billion tranche isn't enough, and sometime early next year, the government announces another $100 billion or something like that. I wonder if that means 5-year fixed rates come down by then, or in advance of it predicting it, perhaps they have by then. I don't know if there's a correlation. I don't know if there's causation, but yeah, maybe there's a correlation going on there. Maybe there's reasons why. And I'm not skilled enough, and I'm not enough of an economist to technically link those two things, but it seems to me that if the government is printing that much money, it's a clear sign that there's no reason for rates to go up anytime soon, because putting rates up is what you do to slow the economy down. Printing money is what you do to speed the economy up when you can't do it by dropping rates anymore. That's what's going on at the moment, and I think that's probably why big banks and small banks are all going, all right, 4 years is a period of time over which we can offer a really small rate. So that's my understanding of the world at the moment. There are still big cash rebates for people that refinance to a better deal. So if you haven't fixed yet and you're thinking about it, you can still get $2,000, $3,000, $4,000 from a lender to switch to them and do that. So if you want to know about that, let me know. And I hope that helps you think through what to do.